So we're now turning then to position limits and position reporting, which are draft RTS 29 and 30, which I guess is the position limits, and the draft ITS 31, which is position reporting, and that's sections 7.2, 7.3 and 7.4 of the CP. So let's start with position limits, and I think, again, Catherine is going to guide us through this.
Yes.
Oh, right. Do you want to give it your Okay, so a brief introduction to our proposals on position limits and position reporting. And again, this is another very substantial development in the commodity derivative market, which is clearly another area which those in this market have thought about a lot and have given us substantial feedback, and hopefully will continue to do so. So just briefly, this new position limit framework means that at EU, we have to set position limits on every commodity derivative traded on a regulated market, an MTF or an OTF, and their economically equivalent OTC contracts. So it's very broad. And the level 1 approach is ESMA should set the methodology, the kind of framework, and then the competent authorities will apply the limits per commodity contract. And then, of course, what we have is where is that balance between having a harmonised approach across the EU and some flexibility, recognising we have different commodities, different markets, and different countries within the EU. So what we have proposed in our consultation paper as the framework methodology is this, that basically for both spot and other months on both cash settled and physically settled, the baseline is 25% of deliverable supply. And then, so that's a starting point, and then the national competent authorities will be able to flex that by 15% either way. So they could set a position limit as low as 10% or as high as 40% of deliverable supply. When using that 15% either way flexibility, there are 7 factors and competent authorities need to consider, and they are taken, they're set at level 1. And that's volatility, maturity of the contract, characteristics of the underlying market, deliverable supply, number and size of participants, and the size of the overall open interest. So that should determine whether they have a lower or higher position limit than 25%. In particular, what we are interested in, so we have set this as an overall framework and we want comments on that. A big question is, where do we get the estimate of deliverable supply? We've said trading venues, and again, we need to look further into how feasible that is, and we will be another significant piece of work under the cost-benefit analysis is in relation to the position limit regime. We also ask in our consultation paper about what we should do with, or how we should frame the position limit regime for liquid contracts. Do we need more flexibility than we've proposed there? As some of you will know, under the non-equity piece, we have, for transparency purposes, set tables where we say some subclasses of commodity derivatives are liquid and others illiquid. Whether we could link that up with illiquid contracts under the position regime, we haven't proposed anything, and it may be not possible because they are for 2 different purposes, but that's a thought there, and any thoughts on that would be welcome. In terms of the more nuts and bolts of how we apply this position regime, we have to specify a number of factors. So we have to specify what we mean by hedging, because when calculating your position, there is a hedging exemption only available to non-financial counterparties, and we cross-refer this to EMIR again. We also define, we have to define what we mean by economically equivalent OTC contracts, and there we say it should be where you explicitly refer to an exchange-traded commodity, or it's substantially got the same characteristics. And then on aggregation, we put some proposals about how you would aggregate your positions, both in other holdings and also if you are a corporate, how you would then aggregate positions if you own a subsidiary. And also we talk a little bit about netting as well, how you net off your procedures. Because this is such a broad-based regime, and because we have the OTC economically equivalent proposal in level 1, we are proposing that reports are made gross, and eventually it will go to the National Competent Authority, and it is going to be at that level that positions get reconciled, because trading venues and investment firms will probably only have a partial picture. And going on to that, then that really brings me to the position reporting, which is how competent authorities are going to regulate this position limit regime. I think David mentioned earlier, our mandate is actually fairly limited in this respect. We have two empowerments. So one is we have to specify what format is used by investment firms who have to report position limits to the competent authority. So just to take a step back, there are two ways in which daily positions need to be reported. So first of all, members will report their positions to the trading venue on a daily basis, and members must also report the positions of their clients, and so on. And then the trading venue forwards all those individual position reports on a daily basis to the NCA. The other way is if you're an investment firm and you do any OTC business, you also have to report daily your positions directly to the competent authority and those of your clients and your clients to the end person. So the NCA, the National Competent Authority, is going to get these position reports from two streams. Our mandate is limited to specifying the format from the stream which goes from the investment firm to the competent authority. But clearly, we could potentially save quite a lot of work and duplication if we have some more harmonised reports going from the trading venue and the investment firms to the NCA. So we would like to explore to what level those formats can be simplified or harmonised. The other format we have to do for reporting is there is going to be a weekly report of aggregated positions, and this has to be compiled only by trading venues when certain thresholds are reached. Those thresholds were actually technical advice given to the Commission in December. So now, in terms of our technical standards, our role is to say what format the report should be for these weekly reports of aggregated positions, which ESMA will then publish on its site. And the weekly reports are correspond to what they have in the US, their commitment of trader reports. So that's a very brief overview of the position limits and reporting regime. And David, hand over to you for questions and comments.
Thanks so much indeed, Catherine. So the position limits regime is trying to set a methodology within some reasonably tight parameters, which national competent authorities then apply. It's not directly setting the limits, it's setting a methodology which is then applied to set the limits. Then on the position reporting side, we are specifying the formats of two sorts of reports, one from investment firms to competent authorities. It seems to us perhaps an omission that we don't also have an empowerment to specify the format of the reports from trading venues to competent authorities. But I think that's a conversation we'd like to carry on with the trading venues informally around whether we can get some standardised reporting just emerging in any event. And then secondly, the format for these weekly commitment of trader reports, which gets sent to ESMA for collation and publication. So that's a whistle-stop tour through the position limits and position reporting RTS proposals. Who would like to start the comment or questions? Right at the back, on the right-hand side. Thank you.
Hi, it's Caitlin McAlane. I'm here with the Managed Funds Association. Obviously, we appreciate that ESMA has had a very difficult task in drafting a methodology that works across such a broad range of different instruments. I think it's fair to say, though, that MFA members would prefer to see a slightly different approach being taken to spot month limits for physically settled contracts and other month limits for physically settled and cash-settled trades. And while we'd agree that deliverable supply is the correct baseline for spot month limits for physically settled trades, we think that gross open interest would work a lot better for other month limits and limits for cash-settled trades. We realise that national competent authorities are able to vary the baseline, based on open interest, but we think that using an open interest baseline for other months would take into account a wider range of hedging activity and would avoid the issue of needing to estimate deliverable supply and what it may be in the future, which is inherently quite an uncertain process. Thanks.
Okay, thank you. That's a very clear comment. Other observations? In the middle at the back there, please.
Hi, Mark Frith from HSBC. On the methodology, I think the article in RTS 30 refers to a person's limit. We're concerned that that basically conflates trading on own account with client principal trading. So could the panel perhaps clarify that those could be split out in a redraft of the RTS or indeed that they interpret it along those lines?
Okay, thank you. And I think there were some questions over here. Let's take these two and then we'll come back. So perhaps Connor first.
Thank you. Quick question, or if you will, comment on the approach on hedging exemption for the application of position limits. Mindful of the discussion we had just before the coffee break about wanting to be, if you will, faithful to what we have in EMIR, both the hedging exemption and the guidance on that. At the same time, I applaud ESMA for taking perhaps a more considered approach on the hedging exemption with regards to the application of position limits. And I note the reference in particular in RTS 30 to adjusting the hedging exemption for exchange-traded derivative contracts. And I would encourage ESMA to make that clear in the RTS and to consider that the guidance that many of us have sought to apply the hedging exemption under EMIR is, of course, guidance that was developed for OTC derivative contracts, and we will be applying this in a much broader context. Thank you.
Yes, and just to emphasise, as I hope I tried to say before the coffee break, I mean, I think, as I say, our starting point was to try and reuse existing concepts. It's not a hard and fast absolute principle, but it's certainly a good starting point. And then I think there's a question a couple of rows back.
Thanks. It's Adam Jacobs from ESMA again. One of the issues that we raised in our response to the May discussion paper was how the position limit regime should be understood as applying in the fund management context, and specifically whether we're right in our assumption that the regime applies at the level of individual funds rather than at the level of the manager, which obviously would be potentially quite a different approach to the CFTC framework. I see in the latest consultation paper that there is no explicit discussion on this point, so just be interested to hear whether ESMA does potentially envisage further guidance on these sort of questions. Also a separate point on reporting. In the May discussion paper, ESMA explored how you might build a regime that protects the anonymity of clients who have to report their information via a chain of intermediaries, whether that's to the venue or via an investment firm to the competent authority. And ESMA looked at the potential models for ensuring that the identification of clients isn't known to other parties in the chain. Again, that wasn't an area that seems to be elaborated on further in the latest consultation paper. So just be interested to know whether it's something that is still on your to-do list for guidelines potentially.
The reason it's not, that particular point is not covered in the latest paper is it's outside the scope of the empowerments. We're not given an empowerment on that. We've just noted, or it's been noted to us in discussion, that it's potentially a problem in the schema that's envisaged in the level one text, and I think we're still interested in potential solutions to that question. But the other points that have been raised in that round of discussion then, so this question about distinguishing an intermediary's limit from the client's limit, Mark's question about the person's limits. possibility of using open interest as the denominator for months other than the spot month when it comes to setting the limits, and our openness to reframing the hedging exemption in the position limits context. And then Adam's question about how do funds fit in. We certainly have discussed that point. Can't quite remember what the answer was. Catherine.
Yeah, so on the open interest, using that as the baseline for other months, that comment has been made to me a few times. I think it's something we will take a look at and reconsider. That doesn't mean that is definitely what the outcome will be, but it's something that we will take away. The point about trading on your own account versus clients' principal trading. So I think we do say in the paper, if you're an intermediary, your client's positions do not have to be aggregated to your own. So I don't know if that actually answers the question or not. If that's not in the RTS and they are a bit rough and ready, they do need to be tidied up. The final version, that will be something to clarify. Yeah, the fund management one. So like David, we've talked about it. I don't know if we've actually come to a conclusion. Do you, Kelston? Is that something that's still open?
Normally on the fund management side, I think what we discussed in May, if I remember correctly, is the sort of disaggregation based on a sort of concept of independence between the various funds which you have in the Transparency Directive. There is a specific empowerment for that, not to aggregate voting rights there. However, in MiFID, we don't have anything equivalent. I think your point was more on the what is the person here, right? Whether it's the management company or the fund itself. How would you see that?
Okay, that's certainly a question that's on our agenda. Apologies that none of us can quite bring to mind whether we'd reached a conclusion on that, but it's certainly on our agenda, Adam. Other comments on this? Carl, Peter.
Yeah, very quickly on the hedging exemption for non-financial firms. We have mentioned that, and we will mention that in our paper, that an ex-ante approval on a transaction-by-transaction basis to take advantage of a hedging exemption doesn't work in reality, because, for example, if a power plant occurs an outage, we have to hedge that commercial risk immediately within the day, within the week, or within the month, as possible, given the existing liquidity. So what we argue is that you would need, like for the position limit regime in the US, or the CFTC regime, a more general ex-ante framework or baseline exemption where we say, okay, usually we enter with that volume of hedging transactions into the market. Is that fine for a regulator? Yes, and then we can do that on a continuous basis without waiting for 40 days or 30 days for the approval and leaving the commercial risk open for a couple of weeks. Essentially, that does not work. So what we would like to see actually, whether we can have an ex-ante general approval and then a kind of ex-post monitoring whether this approval has been complied with. Thank you.
Again, this is a good moment at which just to re-emphasize that because this is a brand new regime for Europe, we are not amending a pre-existing regime. There are inevitably going to be an awful lot of practical implementation questions which lie outside the direct drafting of the RTS. We're fully aware of that, and from our point of view, our work certainly doesn't finish when we hand over the final RTS to the Commission in the summer. Far from it. We then need to turn to what will no doubt be quite a lengthy set of questions and further interaction with market participants about how we, from a practical point of view, give effect to this brand new regime. Question in the front here, and then 2 or 3 rows back.
Hi, Alex Donald, WNBA. Just a comment on the open interest that we spoke about, and more on the commitment to traders report. Given that in power and gas, a tiny fraction of the market is cleared, we have long said from the summer discussion on that open interest for many commodity forward trades is an irrelevant concept, and we query why it would, I know it's come down to from level 1, but why it's relevant at all, other than if you're looking at what trades may be sitting in a CCP, but evidently they're very distant to the venue, and therefore we don't really understand how the two can be conjoined in regulation, and indeed it goes probably against some of the open access provisions, but that's by the by. My question was commitment of trader reports. So we're trying to get our head around if venues are to send the reports of their market participants to you every week, are you not endorsing a very duplicative regime so that if you traded, say, across 20 venues, you would develop the same format, standardized format? Each, say, 100 counterparties would fill in the same format, send it to all 20 venues, who'd then send it on to their different NCOs around the EU27, who'd presumably then send it back to ESMA. It just seems horribly duplicative, given that the venues don't know the commitment of traders because they don't know the positions of their clients, and let alone the chain. This seems to be sort of a very inefficient way of doing what could be done very efficiently through a post-trade reporting regime, which we're now tolerably familiar with in other regulations. And to that end, I also wonder how the venues will get the positions of non-EU participants when they have they are outside of the reach of this regime. So in fact, it will only be EU participants who are participating in the commitment to trader reports, and then presumably only after the hedging and other exemptions are taken out. The value of the end report seems to us to be of limited systemic risk anyway, but I just wondered any comments as to sort of the efficacy of the commitment to trader reports where you're having, say, 20 venues reporting the same things from the same set of participants.
Let's collect a couple more comments. 3 rows back there. Again, just on the commitment of trader reports, all we're empowered to do is to specify the format. So they look nice and shiny and glossy, even if you think they're duplicative. Yes, please.
Yes, Joost Mulder, Finance Watch again. On volatility, I have a question about RTS 29, Article 5, where you explicitly state that the impact of volatility on position limits can only be one directional, namely that, let me just quote, the greater the level of volatility, the lower the overall position limit. Now, if I look at Recital 125, which lists the relevant G20 developments, and I read that text, I'm not going to do it here, and we will submit this in writing as well. We strongly feel that this particular text explains that position limits should be interpreted to interact in both directions with volatility. Can you clarify why you have made this particular assumption? You mentioned in the consultation paper evaluation, let me just grab the text, paragraph 11, that several respondents have argued that volatility typically arises from a lack of liquidity, but then you don't further elaborate and you draw the conclusions as in RTS 29. And then another point on the 25%, just to check, is that purely a reference to international standards, i.e. a CFTC rule, or is that also a reference to other figures such as competition law? What is the background behind choosing this particular baseline figure?
Okay, thank you. Let's take that batch of questions. Any reactions or comments on those?
Yeah. Okay, so I'll go backwards again. So with the 25%, why did we take that as a baseline? Yes, we looked at what the CFTC was doing. We're starting from pretty much zero in the EU. We don't have the background and the experience and the history apart from some regulated markets. So that was really one of the drivers for choosing that number. In terms of volatility being directional, actually, when we talked about how do you take that account of that factor into this methodology, the majority of people were stumped about that and said they didn't see how it would work. And basically, we should take that into account as actually volatility should not be the outcome of position limits. And aside from that, we have struggled to think how we factor that into the methodology. I didn't think we were so directional about that, but if we say lower limits where it's more volatile, then to me that would seem one way to try and cover the market and have more control over it. But if you have a strong view and evidence to back up it should be the other way, then that would be something we would consider. The weekly reports, so the reason for that is not really, I don't think it's systemic, I think it's to bring more transparency to the market. And as David said, this is really all level 1 and our role in this is tiny. But just to take back, what the idea is, each trading venue, when its number of its participants and the size of open interest is above a threshold, it takes those aggregated positions and sends them to us and we publish them. So I don't see why you would have duplicative reports between trading venues if each trading venue has a different contract. You are going to have an aggregated report for each commodity derivative contract. So you're shaking your head, so clearly I've missed something. In commodity derivatives. Well, in that case, what would happen is you would have, if there are different contracts on the different venues, you're going to get what's on one venue, what's on the other, yeah. Well, then each venue will aggregate above the thresholds on one, so you're going to get, as you said, only a piece of the picture. So supposing you have the same contract in different venues, what is going to happen under this regime, unfortunately, is suppose you have more than 30 participants or whatever number is chosen and a certain threshold on one, they will make that weekly report. If on another trading venue they're below the threshold and they have less participants, they will not be obliged to make that weekly report, so they won't make it. So, well, in that case, that's going to be very problematic. I really don't know what the answer to that one is.
That's your point.
You can rest assured we agree this could have been designed in a more efficient way, but we are where we are.
So there's clearly a set of issues around how does the position report, the position limit and position reporting regime clearly envisages that positions are held by a single venue. I mean, it clearly envisages that, and for the most part that is what happens, but clearly there are some markets where contracts are traded across multiple venues, and the level 1 contract is problematic in that context. Okay, any other comments and questions? Okay, I've got one over here and then one over in the far corner. So let's take this one here first.
Thank you, Conor Foley, Norton Rose Fulbright. Just to go back to one point on hedging, and again, I'm not going to talk about the exemption or the guidance necessarily, but we do expect that there will be a definition of financial entity, or at least that's how I understand your statements in Section 7.3 and in RTS 30. If there is, and I go back to a comment made in the consultation paper, the idea that third country persons that may not necessarily be defined as either a financial entity or non-financial entity be treated as they would be if established in the EU, and certainly I know many market participants would welcome that interpretation. It does, if you will, avoid a lot of problems that we have seen in some implementing measures elsewhere in other legislation. Thank you.
Thanks for that comment, Conor. There was a question over on this side.
Thank you. Arun Boucheta from Société Générale. I have a question around position limits and its methodology, and another one on position reporting. On position limits, could you give us more colors on how the deliverable supply will be or could be calculated? I know it's not a easy question, but it's an important one. On position reporting, as you know, we are very much concerned about the fact that we would have to report the positions of our clients and the clients of our clients until the end client is reached. We think that it will be, I would say, practically and legally very, very complicated to obtain this kind of information. Do you have a view on how investment firms could comply in practice with this very complicated obligation? Thank you.
Perhaps if I take that last question and then Catherine might pick up on the methodology question. I think as we responded to an earlier question, that's not something that is within the purview of the mandates we've been given. We know it's a practical problem. We can see it's a practical problem, and certainly it's been raised with us as a practical problem. I think we are open to seeing what solutions people can think of. I don't necessarily think it's for us as ESMA to impose a solution. The obligation and the reporting framework comes from the level 1 construct, and we're keen to facilitate discussion about how a solution might emerge, but I don't think it's currently our position that we will devise and impose a solution out with what market participants themselves think about how the problem might be handled. Catherine, on the methodology question.
How is deliverable supply going to be calculated? I was thinking if I was a politician, I'd just kind of waffle and then answer another question. But the answer is we don't know. It's something we need to think further about. We said in our paper we would like the trading venues to provide that information to us. And I am sure that a number of trading venues will come back and say this is problematic. And I think it goes back to David's point about the regime was envisaged for a world where commodity derivatives and flagship ones are generally traded on one trading venue, and that would perhaps be slightly more simpler there, perhaps not always. But when you bring MTFs and OTFs into this, it becomes more challenging. And it's also why we're struggling a bit about how you set the other months, because feedback we got was, and we've just had it now, is certain venues do not have sight of what the overall open interest is. Others don't have deliverable supply. So this is a very big piece that we need to work on. We need to work on coming up with some measurables, and it's certainly something, when I keep talking about this cost-benefit analysis, we're looking for input there.
But I think it's reasonable to say that we agree that in order for this set of regimes to work, people need to be working to a single number for each relevant contract. A bit like the ancillary activity test we were talking about earlier, in relation to the trading. I think we recognise that everybody needs to use the same figure in terms of working out what percentage of European trading they account for. And I think we can recognise that potentially there's a role for us in coordinating the publication of such figures. And that's certainly something we're reflecting on. Any other comments or questions on position limits and position reporting? One here, please.
Peter Pinto from AFME. My initial question was actually on the definition of the methodology to deliver supply, particularly on non-spot months, but you have already addressed that. I gather for non-spot months it will be even more challenging. But in relation to the other point you mentioned as a critical element on this position limit mechanism is the netting of an OTC economic equivalent contracts. And you said that what matters is, of course, the overall economic exposure to the commodity. Would you consider as potentially economic equivalent contracts non-MiFID commodities contracts?
Well, I'm wondering there if you're thinking about the carve-out under C6, where you have a carve-out for physically settled gas and power, which are settled on OTC, and they're non-financial instruments. And we do say in our paper that if it's not a financial instrument, you couldn't net it off. So that's the view we've taken so far. So the answer is no in the paper at the moment.
So don't forget that an economically equivalent contract would also then have a position limit. It's a swing and roundabout question. The way that the construct works, OTC contracts that are defined as economically equivalent are then subject to a position limit.
Yeah, but if they are non-MiFID by themselves, so then they would not be subject to a position limit, but they would potentially impact the overall firm exposure to that commodity.
In which case they can't. The economically equivalent contracts must be financial instruments, I think. That's what we're saying. So I did say at the beginning of the day I wouldn't make any definitive statements. I just did. I'm sorry. It's getting quite late, obviously. But we do say that in the CP, I think. So I think I'm on safe ground. Any final comments on position limits and position reporting? Right at the back, thank you.
Gunnar Stangl, Commerzbank. The whole framework for the position limits looks a lot as if it's actually attuned to notionals and open net open interest equivalents. It feels as if that won't work at all for options, in particular for far out of the money options, which in nominal terms obviously are looking quite disproportionate relative to outstanding terms. Shouldn't there be some additional information in the methodology about delta equivalents in order to actually take account of options? Because otherwise, basically, there won't be any near-term options or far out of money options. Another aspect, in particular with option strategies, is that inter-expiry strategies where you're rolling positions, where you've got strings of options across multiple expiries, actually would normally be, from an economical perspective, be netted against each other and looked at the total risk basis. Obviously, running this against segregated limits results in basically disconnecting this and making it effectively impossible to adopt efficient hedging strategies here.
Okay, thank you. I think that's a helpful comment. And then question in the middle.
Aude Philippi from Parnext. Yeah, I had just a comment when it comes to assessing deliverable supply or open interest for non-spot months. I think we should not forget that for non-very liquid markets, if you take open interest, and this is true for long-term maturities especially, you could have also problems. Because of course, if the market is not very liquid, then the open interest is not liquid as well, is not very big as well. And especially for gas and power, as we could expect maybe a shrink of liquidity, or at least some of us expect a shrink of liquidity in financial instruments. We could be worried by position limits to be based on open interest for long-term maturities.
Thank you. I think that's a good cue to raise that in the CP we flag that we recognise that illiquidity could be an important feature of many of these contracts and that we need to devise some way in the methodology of recognising that. So, for example, one of the factors that the Level 1 text says should be taken into account in the methodology is the number of participants in the market. And so we're flagging in the CP that we recognise that we need to develop that thinking a little bit more fully for the final standards, noting that the position limit of even 40% may not be appropriate for the most illiquid contracts. Are there any final comments on the commodity derivatives position limits and position reporting section? Okay, well let me draw that to a close then, and thank you very much indeed for that. We're going to move now to the investor protection and intermediaries section. And I think that necessitates a different team up on the platform. I am hoping that they are in the auditorium somewhere. Come up to the platform. Okay, we're still just waiting for a couple more people, so we'll just, without leaving the auditorium, just take a couple of minutes of break whilst we reassemble a new team up on the platform here. So don't go far. Sorry, no, don't even go. But you can chat to your neighbour whilst we. Laurent is here. Here he is. Come up to the platform. Well, that 60 seconds was well worth waiting for me personally, because Laurent de Gabriel, who's the Director of Intermediaries at ESMA, has just arrived, and he has volunteered to chair this final session. So I get to step down from the stage at this point. So I shall leave you in the very capable hands of Laurent for the final section. But just a personal thank you from me for your participation today, and don't forget, 2nd of March. Is the deadline for the responses to the main CP, and then the 20th of March is the deadline for the responses to the supplementary which we issued yesterday. We look forward to getting those carefully considered responses. Thank you.
Thanks, David, and good afternoon, everyone. I know it has been a long day, so for most of you, but just bear with us for a few more minutes, or even longer, depending on you. I mean, same rule of engagement, so we are here to listen and possibly clarify some issues, not to provide feedback, I'm afraid. And just to be clear about the scope of the discussion, which is about the consultation on the technical standard related to investor protection, mostly best execution, and that's the only thing we intend to cover. So I'm sure some of you may have some comments about the technical advice that was delivered late last year. Good, but we do not intend to cover that. So just wanted to make it explicit from the start to avoid any disappointment later on. So there are two main topics that we'd like to cover, which have to do with best execution. And I will let maybe Philippe to take us quickly through the issue. Philippe has been looking at those matters, and then we'll hand over to Matteo for the second topic. And I really should have started by introducing the people around me. So Philippe Brennan is in my team, working on a number of technical standards. Matteo Rava as well, and then I'm sure you know Salvatore Agnoni, who has been the lead coordinator for all of the MiFID 2 project in my team on investor protection issues. So without further ado, Philippe, do you want to take us through that?
Thank you, Ron. So Article 27 has set ESMA two main tasks in respect to best execution. Both of these involve the development of regulatory technical standards. So firstly, ESMA must develop standards that specify the content, format, frequency of the data relating to the quality of the execution that needs to be published by execution venues. And secondly, ESMA must develop standards that specify the content and format of information to be published by investment firms. And this is in relation to the actual routing of client orders to their top 5 venues in terms of volume, and to the execution quality that they have achieved for all executed orders over the previous year. So in the discussion paper last May, we set out initial views on the information to be published by both the venues and the firms, and then the consultation paper, I think, has adopted a more calibrated approach to some of those proposals. Just to briefly focus on the execution quality data to be published by venues, we have set out in the CP that this should include information on the price, the cost, the speed, and the actual likelihood of execution, and the other relevant factors. And this comes directly from the actual level 1 itself. So while the information that we propose is quite prescribed, we effectively have been required to deliver such proposals. So what we have proposed is that all execution venues, including systematic internalizers and market makers, should be included too, so that we can allow a proper comparison between them in respect of the financial instruments that have been executed. We propose that this information should be published on a quarterly basis, and that should be broken up into monthly reports, which then would have the information from each day that the execution venue had delivered or was operating. To make this information comparable, as I said, we're requiring that it should be for all execution venues. But to take account of the actual different market mechanisms, we're proposing that there should be specific information requirements for quote-driven markets and then for order-driven markets. And these mainly relate to how you would measure the speed. Then to briefly move on to the information to be provided by investment firms. Again, we've been tasked with requiring periodic information. And this is on the order flow to the top 5 execution venues. Now, this is in respect of each class of financial instrument. So this is something that ESMA has been tasked to do, to develop what classes of financial instrument in each specific financial instrument. So we had to prepare this information. So again, what we sought to do in this instance is actually build on some of the existing work done by our colleagues in secondary markets under their requirements under Article 9.5 of MiFIR. In relation to some of the transparency taxonomy that has been developed. Then moving on to the quality of the information that has to be in relation to the quality of the execution. Again, it doesn't say an awful lot in this instance in actually level 1, but what we try to do is to tie in as much as we can with the existing requirements in, for example, what's required under the mandate for us on best execution on the advice. And also then to link that with the requirement on execution venues to publish information in respect of their execution, so that effectively what you would see is a holistic approach and almost to execution quality, so that the firms are looking at the venues and are looking at themselves in terms of what they are saying in their best execution policies. So the objective of all this information is that until MiFID 2 came along, there was no requirement on either investment firms or execution venues to publish any information in respect of execution quality or indeed of order flow for investment firms. So we considered the information to be published by the execution venues should allow firms to determine where they can get best execution for their clients, and then that the information to be published by the investment firms themselves should allow clients to assess or to basically review how the firms are achieving best execution for them. So that's just a brief introduction. I'll hand it back to Laurent.
Fine, thanks, Philippe. So any questions, need for clarification, comments, feedback on those issues? Yep. Go ahead, Guillaume. Yeah, gentleman with a white shirt over there. Guillaume?
Yes, thank you. First, I would like to...
You have a mic coming to you.
Thank you. Guillaume Prache, Better Finance, the European Federation of Financial Services Users. So first, I think it's very good that ESMA extends this information obligation to all venues, including systematic internalizers. My question is specifically on these systematic internalizers. Will you collect adequate information to identify whether they comply with the best execution principles in MiFID? Because we have a lot of evidence, especially, for example, for equity warrants proposed to individual investors, where systematically, maybe because it's a systematic internalizer, maybe, when they buy, they get the upper limit of the offer spread, and when they sell, they get systematically the lower limit of the offer spread, the bid offer spread that is published. So I would like to know if this, you will have enough adequate information to spot this potential big detriment to individual investors. Thank you.
Thank you. Let's take a couple of comments and then we'll try to answer them. Yep, the man on the mic stream, right?
Thanks. Arjun Singh Michel from the Investment Association. This is a little convoluted, so I'll try to keep this as simple as possible. As investment firms, we play two roles insofar as the best execution requirements are concerned. One, of course, is as recipients of information from execution venues, and secondly, as providers of information to our underlying clients. We think that the RTS 6 and 7 go well beyond the mandate set out at the level 1, particularly insofar as the actual number of fields of information that will be required. So by our calculation, if you are an asset manager who deals in all asset classes, you will be in receipt of 31,920 individual fields of information from your execution venues, from your top 5 venues. And you'll be in receipt of an additional 18,000 fields of information from your remaining venues. That level of information we think is meaningless because it introduces noise when we then take those fields that are provided to us by the execution venues and convert that into something that is meaningful for our underlying clients. And providing underlying clients with over 50,000 fields of individual information for underlying clients and funds it is not cost effective or efficient for either the execution venues and perhaps more importantly for us to provide that level of information to clients. And for clients it is confusing information, it is not complete information either, and it's not meaningful information. In addition, the actual timing of when these reports need to be published is challenging. So the requirement on execution venues is to publish quarterly, whereas the requirement on the investment firm is to make the annual publication to clients 1 month after the end of the year, which is the same time that the execution venue will have to provide us with their report for quarter 4. So the day we receive the information from the execution venue on quarter 4 is the same day we have to provide our clients with the best execution information that encompasses quarter 4. So to us there seems to be an inherent mismatch in the actual timing of information that we'll need to publish to our clients. We have a different proposal that we're going to be putting forward to ESMA in response, where rather than over 50,000 fields of information, we receive 255 fields of information from our execution venues, from the top 5 execution venues, and provide that information in a succinct manner to our underlying clients, where we can continue to demonstrate best execution to our clients, and where execution venues, including SIs, will be able to demonstrate that we have in turn received best execution from them.
Thank you. I'm not sure I understood the organization that you were representing.
It's formerly known as the IMA in the UK.
Okay, thanks. Yes, gentleman in the front.
I'm Jeffrey Hogan from BGC, and I want to directly pick up on that theme and speaking on behalf of an execution venue. So on the first day that the rules will take effect, we'll have approximately 150,000 separate instruments hardwired into our electronic trading system, and the daily delta of new instruments we put on our system trading by voice is approximately 2,000. So at the end of the first year that the rules are in place, we'll have 500,000 minimum instruments where we'll have to be capturing that information to provide best execution analysis, and the majority of those instruments will be illiquid. So in conjunction with the information that the investment advisors have to give to their clients, there'll be a tsunami of information coming to ESMA on a quarterly basis, much of which will be irrelevant because it's based on the episodicity of illiquid products. So in addition to making sure the Commission and ESMA is aware of those numbers, I'm asking whether ESMA has contemplated the best execution requirement information coming from venues to be restricted to liquid instruments.
Thanks for that. Yes, let's move on the...
This is Bauer, German Savings Bank Association from Germany, and speaking on behalf of the German banking industry as well. I want to stress the point of my EMA and my the other participants, and point out another effect. It's not only the vast and stress the argument that there'll be a tsunami of information, because letting aside the vast number of financial instruments, we have to at least take into account the technical advice and the final report, section 3.3, and the low threshold for systematic analysis. And this leads to the effect that we're guessing that about 90% of German banks would be qualified as systematic analysis in bonds. And I think this is valid for European universal banks as well, at least for a vast majority. And if you multiply the financial instruments with the number of SIs, you'd stress the tsunami argument there. And at least we think it would be really good idea to for investment firms, but also for investor protection issues, to limit the content of RTS 6, Article 2.3, at least on liquid SIs. And I'd be interested how do you see that point from investor and investment firms' side.
Thanks for that. So, are there other, yep, at the back over there?
Hi, thanks. I'm Silvia Marino from CaixaBank, and my question relates to the regulatory technical standard number 7. So it's more about investment firms publishing all this information about best execution, and the particular case of discretionary portfolio manager, where there is only transmission of orders. So in that case, there is no client order, and of course, you are not the entity that you are executing, executing the transaction. Of course, you are subject to other best execution requirements that are presented in the technical advice. But my understanding and our understanding is that you are not subject to the publication under this RTS, because it's discretionary portfolio manager where you transmit the orders, so you don't execute them. Thank you.
Is that okay? Yeah. So, Philippe, could you just maybe clarify the last question, because I think this one is easy.
Yeah, these particular RTS are specifically just for the execution of client orders. So if there's a transmission, these RTS. But as you mentioned, the technical advice also has an opinion on that, and it gave the advice to the Commission that there should be some level of correlation between what we're doing for firms that execute orders, as there should be done for those firms that receive and transmit orders, which would capture the portfolio managers that are transmitting an order. But that's in the hands of the Commission. That's not for these RTS.
Thanks, Philippe. Are there other comments on the amount of data and the scope of the entities that's subject to that before we enter? Yeah, gentleman at the back over there. If you could have a mic over there, yeah.
Thank you. Thank you for the opportunity. Stuart Caswell with the Managed Funds Association. I want to, elaborate on the comment that was just made. For hedge fund managers, as I understand it, we would be required to disclose publicly the prime brokers to which we had sent orders, and as well as the general areas of investment that we had made. We think that actually will harm our ability to service our investors. We have, as fiduciaries, the obligation to obtain best execution, but putting that information out as to which prime brokers we use and the nature of our investments could allow reverse engineering of our strategies. We're as strongly in favor of best execution responsibilities as anyone, but we just don't think that these two aspects of public disclosure will further that objective. Thank you.
Thanks. Yeah, gentleman in the front with the retire, and then we'll try to come up with some comments.
Thank you, Andrew Bowley at Nomura. I guess ESMA's having to deal with a difficult ambiguity in level 1 around definition of trading venues versus execution venues, and has chosen to include market makers in the second of those categories. Given particularly in equities that a firm is unable to target a market maker that is providing liquidity to an exchange specifically, and can only anonymously send orders to a particular venue, why do you see that market makers should be included as providers of data for this service?
Thanks for that. So let's maybe tackle some of those questions, especially the one on the amount of data, and then maybe the one from Mr. Prash on the warrant.
Yes. So indeed, thank you for the questions. The one on the amount of data and on the tsunami of information, which comes together also with the inclusion under the scope of these obligations of systematic internalizers, and which will also lead us to reply to Mr. Prash. The amount of data. This comes from a specific choice of the level 1 in identifying the financial instruments to which those obligations should apply. And in this respect, there was a comment on the fact that our proposals may be seen as going beyond level 1 in terms of fields which are required and which are proposed. I have to say that our mandate there is exactly the one to specify the content of data and to give a specific a regulatory framework which provides useful information in order to be able then to deliver on best execution. And in this respect, the scope of the level 1 includes any financial instruments, and we would see some difficulties under level 1, exactly under level 1, to narrow down the scope of these obligations to the liquid instruments. So the question was whether there has been any discussion on that. Indeed, there was some discussion in the preparatory phase of it, but the level 1, as we see it, does not leave so much room to make a distinction between financial instruments and financial instruments, so liquid ones and non-liquid ones. However, of course, this is the consultation paper, which follows a previous discussion paper. Of course, it's also useful to get input from the market and from different stakeholders. In terms of SIs and coverage of SIs, indeed, this also comes from the level 1, which explicitly mention SIs in paragraph 3. So in this respect, it is not possible to exempt specific SIs or specific situations in which SIs are. Then I understand that as a result of MiFID II, so we can expect to have a number of SIs which is an increased number compared to MiFID I. This is clear, but we have to consider also the overall purpose of this legislative intervention in this respect. And the overall purpose was on the side of the SIs, and here I speak under the control of Carsten, of course, to identify also criteria in order to be able to identify SIs and to
let's say, to capture these entities. So that comes from the definition of the criteria in the level 1. And if we go to the regulatory objectives under the best execution obligations, indeed the regulatory objective was exactly to improve the ability of firms in the interest also of investors to deliver on best execution in a situation in which probably this is one of the obligations on which the results under MiFID I are the least satisfactory in the market. So this is the result of supervisory action also conducted by competent authorities, where we can see that firms struggle with delivering best execution for their clients. So the overall intervention here has been to introduce under the best execution obligations some, on the best execution requirements, some obligations to make public information for execution venues and for investment firms. And this action, this regulatory action, together with the regulatory action in the field of, in the area of transparency, of consolidated tape, of course, should be able to improve the ability of firms to deliver on best execution, to demonstrate best execution to competent authorities and to clients. So essentially, we take note of the comment on the number of fields which and the amount of information that we are proposing, and for sure the consultation under a technical level can be helpful to identify some fields that industry and investors may consider not being strictly necessary. But in general, the philosophy behind this regulatory intervention is exactly that one, to ensure that execution venues publish data on execution quality in a granular way, and that investment firms publish on their side the top execution venues and the execution quality data that they have. Coming indeed to the question, Mr. Prash, this is also the hope that we share, that the overall result of this regulatory intervention may be supplemented by an additional supervisory action, can also address the issue raised of SIs, which are investment firms providing a service to the client, not being able in some cases to provide best execution or to comply with best execution. So I think the overall result of the regulatory action should lead to a better result in this respect. On a technical point which was raised, the execution venues. So I think that we have. I would like simply to remind that, yes, the level 1 mentions and define trading venues, which are regulated markets, MTF and OTF, but already under the existing level 2 directive, we have a definition of execution venues for the purpose of best execution. And indeed, that definition already today includes market makers and other liquidity providers on top of size, of course.
Thank you, Salvatore. I think we left one question which was on the prime brokers, maybe. So, Philippe, do you want to try to cover that?
In relation to the, I think, the portfolio manager in terms of having to publish the execution venues that they use. Again, this comes from the level 1 in 27.6, where the obligation is on the firm to publish and to make public the top 5 executing venues that it uses in terms of client, in terms of the kind of volume of client orders. And we've tried to accommodate concerns in relation to this by only requiring the publication of the percentage of client orders in terms of the volume. That's the amount of publication that we're looking for, not the actual specific numbers or the specific volume. So that's an attempt to address concerns there.
Thank you. Yes, gentleman in the front. A mic is coming to you at some point.
Peter Weston from Tradition. A few points just to put them up for discussion. On the point about the tsunami of data, it will be impossible for people to cope with it as it's currently structured. In terms of not being able to restrict the data to, say, just liquid instruments, I think ESMA has to bear in mind the usefulness of the data to the recipients. As was described in the introduction, it was about the usefulness of the data to recipients of it. For the recipients of some of the detail of information regarding illiquid instruments, which will be, as at that point of time, in the middle of the previous quarter, which will be completely irrelevant potentially for future circumstances, that is potentially very misleading and potentially dangerous to put out there because it's such a lack of foundation that it's potentially misleading to the actual users of the marketplace. One point in terms of the timescales on the publications of the reports. Obviously, if there are a lot of illiquid instruments, covered where, as it stands at the moment, phenomenally granular information is required, that potentially runs into the publication of individual transaction details effectively before certain post-trade waivers have actually run out, or providing that information before it would do otherwise. Final point as well, on the whole of the Article 27, that excludes eligible counterparts from those obligations, and this is where the obligation to provide this data holds. So be grateful on any comments about whether for pure eligible counterparty venues, for example, you'd still expect this type of data to be provided.
Thank you. Yes, the gentleman at the back over there.
Thanks. Mark Frith, HSBC. On the requirement to publish information on the quality of execution, I think there's a provision in the RTS which requires firms to publish a summary of analysis and conclusions of that information as well. I just wondered if ESMA are cognizant that the level 1 mandate relates to the information only and could be read not to extend to analysis and conclusions of that information, and perhaps if a summary of the information is required instead of the analysis and conclusions, that might be more in keeping with the level 1 mandate, and indeed many end users of the information might want to draw their own analysis and conclusions as well.
Thank you. I think there was a question on the right over there. On the right over there, the gentleman.
Salvatore, if I may challenge you with respect on your response insofar as going beyond the level 1 text, in paragraph 30 of RTS 6, there's mention of the standard taxonomy, and I don't know from where, or it is unclear from where or to what the standard taxonomy relates. And the standard taxonomy defines 38 financial instruments. 38 financial instruments to us, anyway, to those of us who will be in receipt of this information from execution venues and then have to spend time to analyze the monthly reports and then make disclosures to clients, does to us seem to be an extension, perhaps, of what was meant in the level 1 text, insofar as our interpretation of the level 1 text is concerned. In addition, just to push the point on the usefulness of the information, when we receive with almost 32,000 fields from our fields of information from our top five execution venues, that information to us and the granularity of that information to us, we do not think is meaningful or useful enough for us to provide any sort of meaningful or useful disclosure to our underlying clients on an annual basis. Plus, I wondered if you could perhaps comment on the issue of timing, the timing issue, if you could, given that we need to make these annual disclosures to our clients 1 month after the end of the year, whereas the execution venues need to provide us with the information 1 month after the end of the quarter. So there seems to be a conflict between the information we can provide to clients and actually receiving the information from execution venues. And finally, on the third country aspect, third country execution venues do not have any requirements placed upon them to provide us with the information required in RTS 6 and 7. So if one of our top 5 execution venues happens to be a non-EU execution venue, and they will not provide us with this information, or they are not set up to provide us with this information, who will be held legally responsible for the lack of information if we are therefore unable to make the annual disclosure to our underlying clients?
Thanks for that. By the way, you may never not challenge Salvatore, but we're happy for your feedback. Thanks. I think on the timing, because the point has been mentioned several times, I think we will look at that, and I think there is a bit of room to do that. On the summary and the analysis, I mean, Philippe, do you want to take that? I think
I do take the point, but I think at the same time, at level 1 just requires information. I think what we're trying to set out in the RTS is what should be the content of that information, or how the information should be construed. I think it's something that we can certainly have a look at again.
Then we are left with a question on the eligible counterparties, Salvatore?
Yes, so the issue of the eligible counterparty is absolutely true that the Article 27 does not apply to the relationship with the eligible counterparties in the provision as of investment services, of course. But here the rules that we have, they are general disclosure rules which apply to venues and investment firms. So they are not information or disclosure obligations which apply to the relationship, to the brokerage relationship between an investment firm, a bank, and a client, but they are general disclosure obligations. So they will apply to the execution, to the trading venues and the execution venues, depending on the types of obligation that we have, irrespective of the type of traders that they serve and who are members of the venue. So these are general obligations which will apply to all venues.
Thank you, Salvatore. Any other comment? No? Yes, last one in the middle. Could we have a mic in the middle?
Brett Chappell, Nordea Investment Management. Concerned about efficiency and time. We have many discretionary mandates, which we are working, and especially on OTC illiquid markets, such as the credit markets, that normally the bid-offer spreads are there for 1 million. But if you have a certain size, 5, 10 million euros, up to 30 million euros, what you will find out is that if I go through and I have to carry out a transaction, it could end up that I'm hitting below the bid or lifting above the offer. And afterwards, when the salespeople who are speaking to the clients have to go out and describe why we do this, it's going to be very, very difficult because they'll be inundated with so much data. My fear is that for the clients for whom we're managing money, the pension funds and the institutionals, that we will end up spending more time discussing with them why we traded this and trying to decipher the data than actually going out and getting the business done for them. And I think, especially on the OTC illiquid instruments, this is going to be causing a big problem in the future. So I just hope that you're aware that sometimes best price execution does not mean going out for 3 best prices
or technically trading inside the bid-offer spread.
Thanks for that comment. So if no further comment on that issue, and I think we took due note of the timing issue, the tsunami of data, the issue of liquid versus illiquid instruments. I think we clarified the scope of the people that would have be subject to that and the very little flexibility that we have from the level 1. But I think we heard the message on a couple of points. So thanks for that. I suggest we move to the second topic that we wanted to cover. Matteo, do you want to introduce the topic briefly?
Absolutely, yes. We have left, at the end of the day, three topics actually that, although equally interesting and complex, we feel are a little less controversial. So I will present them quite briefly all together before opening up for any comments. The first ones are the regulatory and implementing technical standards we have to draft under Article 7.4 and 7.5 of MiFID on the process for the authorization of investment firms. And I can say here that we basically did not need to reinvent the wheel. What we did was more try to standardize and harmonize what are the current existing national practices on the authorization of investment firms. So nothing really new, and that we think will have a very big impact on the market. A second topic that I will briefly present are the regulatory and implementing technical standards that we will have to develop under Article 34 and 35 of MiFID II, relating to the passporting of investment services, both done with or without a branch by EU firms. Again, also on this topic, we had quite numerous previous CSER documents on this. So what we did was actually translate in regulatory technical standard, implementing technical standard form, the old CSER guidelines, Q&As, et cetera, So again, nothing really new, more a work of harmonizing and standardizing and maybe adapting to the small changes that MiFID II brought to MiFID in respect to the topic of passporting. And the last topic, which is probably the most interesting one, is the one on third country firms. Although here I must underline that although the third country firm regime is definitely, of MiFIR, is definitely something very interesting and something very new that will definitely have an impact on the market, the mandate that ESMA has received is very, very limited in scope, because the regulatory technical standard that we need to draft under Article 46.7 of MiFIR is simply related to the information that the third country firm needs to provide to ESMA in order to be registered with ESMA. And again, ESMA won't actually be, let me say, a supervisor. So again, the kind of information that you have seen in the draft consultation paper is quite light, and it basically will help ESMA identify who the firm is, and especially who the firm's supervisor is and what kind of services it is authorized to provide in its home member state. But again, some kind of very kind of light information in this respect. So again, something not really controversial. So I'm happy to open up for any comments or input should you have on any of these three topics.
Thank you, Matteo. So any comment on those three? Okay, so it's either exhaustion or no comment, so we'll go for no comment. I think we've covered most of the topics we wanted to cover, so with that, I would like to thank you very much for attending this very interesting but slightly long day. It was really good to have your input, and we'll take as much as possible into consideration the input we received. Many thanks.